So if the Dow stayed exactly where it is, which I doubt in nominal terms, gold would need to go up. It's 10.62. So to go sub 1, it would need to go up 11 times from here. 11 times. You're at 4.5. That's over 44,000. You know, we're going to be talking 50,000 gold when that happens. However, if the Dow halves and takes half of that 11, then you only have to go up 6.5 times because it's halved. If it loses 70%, who knows? We're going 4 digits silver. I think you could have, you're going to drop 9.99. That's when I'll start stepping back, buying more silver and maybe rotating out of the silver side of things. And in an overshoot, as I say, you could actually have a spike in silver that meets or even slightly beats for a second even the price of gold.
The financial markets may be approaching a historic dislocation in which the Dow-to-Gold ratio falls below 1, signaling a massive transfer of wealth from equities to hard assets. This scenario implies gold prices soaring into the tens of thousands, potentially dragging silver into a 4-digit valuation during an extreme volatility event. Francishunt, a technical analyst and trader known as the market sniper, breaks down the mathematics of this potential reset. He calculates that with the current ratio at 10.62, gold would need to rise 11 times, reaching nearly $50,000, to achieve parity if equities remain stagnant. Hunt further warns of a bizarre overshoot, reminiscent of negative oil prices, in which a supply squeeze could cause silver to spike so violently that it briefly matches or exceeds gold's price, creating an unprecedented exit opportunity for strategic investors. Now we present the clips from Francishunt's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
People aren't talking about gold and silver right now. They aren't talking about it at all. It's almost meaningfully. You get a little bit of mention, but it's almost, well, it's got to be near a top right now. It's always to say, well, that's it. You know, it's done well, but, you know, no, it hasn't even started. Haven't even started. We're going a lot higher, a lot further. That's why I'm the silver messiah. And silver goes to the single digit, and I think it could even go 3. You know, once it's gone single in a blow-off moment, because you just don't start mines that fast. 60-70% of production is byproduct. They aren't down there for the silver. They're down there for the zinc, the copper, the gold, the other items. They're just getting it while it's there if it's lying around in small numbers. How do you boost that supply? You don't. You can't. They're not there for it. They're choosing to dig a hole there for zinc, not for silver. That might, you know, it's just incidental. They pick some up. You're going to need much higher prices for grades that are reducing to be worth getting. And the only thing that fixes it is price. And you've got the ECG, the whole battery and agenda that BlackRock brought you. People don't hate BlackRock enough. You've got that whole agenda that's still in the West made it very hard. Places like Canada and various other places. Permitting takes ages, etc., etc. How do you fix supply issues with that? A very long time and much, much higher prices for what's around. So we're going 4 digits silver. I think you could have, you're going to drop 9.99. That's when I'll start stepping back, buying more silver and maybe rotating out of the silver side of things. And in an overshoot, as I say, in the most bizarre overshoot, just like we called zero oil and negative you got negative in the futures. No one would have, if you go onto poly markets and put a bet for that, no one would be betting on that. You could actually have a spike in silver that meets or even slightly beats for a second even the price of gold, just because of structural issues. It wouldn't be permanent, but look what happened in oil. You have to have a complete shakeout, and because people can't suddenly, Samsung can't start using gold or platinum, you know, in lieu of silver. It's a different metal. It has different characteristics. You have to check. You have to retool your production lines. You have to do everything. So who knows? You don't want to play too long in the overshoot phase, which is why I say the minute you go single digit, I'll be rotating out. But there'll still be potential for blow-offs in there that could, weird stuff is going to happen. But this is the Dow Jones divided by a gold ounce. since 1913. The Fed was created here. The Fed was created here. That's your pre-Fed stability, Dow Jones and gold ounces. Since the creation of the Fed, bang, you went to 18 ounces of gold to get the Dow. Then you crashed to 1.9. Then you pumped to 28. Then you had the huge stagflation, the Vietnam War. You did this halfway, hit the splitter, the midpoint here. You did this halftime rally and then dump. That was gold going to, listen to it, 1981 highs. Then they removed, because of Nixon in 71, somewhere over here, they removed the dollar being on the gold standard. So now they had gold where they wanted it, and we did the financialization of everything. Stocks and housing, pumpity, 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 pump. 44 gold ounces at this point to buy you one basket of the Dow. Then suddenly, after 99, Brown's bottom, 2000, 2001, sold all Britain's gold, changed the name on the clipboard, stole it from the citizens, gave it to banker mates that put him in power. Guess what happened? You sold off down to here, 2011, the subprime crash, terrible, very strong for gold, terrible for fiats, QE, you name it. You got your rally when they had 2011 and they eventually broke the downtrend. Then you started your half time, you met your half time, and now you're starting to move down. It's a bigger version of what happened here. It's a bigger version of what happened here. You're going here, you're going below 1 gold ounce to buy you a basket of the Dow. Well, right now you're at 10 is required. Don't forget you're at 44 up here. So you've already done a large part of that move. But in log scale, this is a log scale chart, percentage terms, it's huge still to go. So if the Dow stayed exactly where it is, which I doubt in nominal terms, gold would need to go up. It's 10.62. So to go sub 1, it would need to go up 11 times from here. 11 times. You're at 4.5. That's over 44,000. You know, we're going to be talking 50,000 gold when that happens. However, if the Dow halves and takes half of that 11, then you only have to go up 6.5 times because it's halved. If it loses 70%, who knows? But I foresee Newsweek running the death of equity articles covers on their future magazines, and the cult of gold, the cult of this, and whatever, and many other things. So that just shows you. And by the way, that's the Fed stability that they introduced. You know, here's 1913, reminder through there. And this is the pump and dump total stability. Of course, who's on the long side and knows when they're going to be do liquidity provision and is long and short all the right assets? You can guess it. Who's getting a shave every time? You're crazy. And when they need a pump up, blow off top, and they need to bring retail in for the final high, you know you're being set up to be sheared and that it's going to fail.
The structural crisis in silver is driven by the critical fact that nearly 70% of global supply is merely a byproduct of base metal mining, rendering production unresponsive to price spikes. Since miners prioritize zinc or copper, rising silver prices cannot trigger immediate supply increases, particularly given strict Western permitting delays. This inelasticity sets the stage for a potential 4-digit valuation, where industrial panic, fueled by manufacturers unable to substitute the metal, could briefly force silver to trade at parity with gold in a chaotic overshoot. This volatility mirrors the long-term deterioration of the Dow-to-Gold ratio, which exposes the instability introduced by the Federal Reserve since 1913. The analysis forecasts a collapse from the current ratio of 10 to below 1, a reversion that implies gold reaching $50,000 if equities remain flat. This shift signals a definitive end to the financialized pump-and-dump cycle, marking a return to tangible assets as the only defense against a currency system designed to liquidate the public's wealth. Let's get back to the interview.
Everyone's still expecting massive interest rate cuts because recession. And we're like, you're so late, you're half a cycle behind the curve. It was a recession, we've been calling it for 2-3 years. But the problem you have is you're not seeing that this isn't a normal environment of recession where you have scope to cut rates. Cutting rates means buyers are coming in for the bond market. Just like I described, this isn't the normal silver market. You get extreme circumstances in extreme times. This isn't buyers with retail leverage chasing up the market successfully. This is commercials demanding delivery type bull market and a lack of supply. And when you're in that situation, you're the same situation here. Interest rates have to go up because the debt and the fiat is debasing and no one wants to buy it. It's not paying a true return. And the more you're getting exceptional returns out of silver and gold, the less you get investment in bond markets. You'll get sectorial rotation out of treasuries into silver and gold. And we haven't even started yet. The average hedge fund is on between 1% and 2%, but that will become 5 and 10 if they want to get paid better, which they all do. They all want the new Porsche. They will want to get paid better. So they'll start pushing the boat out and going 5 to 10, etc., etc. And then people will start waking up to it and buying themselves. Apart from us sound money guys that have been around since Kingdom Come, there is no mainstream adoption. We've never been at lower levels. And in actual fact, the increase in rates on the debt market is actually indicative of the death of it as a reserve asset. And the more it dies as a reserve asset, where does the money leave to? It goes back to the preservational classic, gold and silver. So rising rates is bullish. And you showed that silver climbing on a rising rate cycle because Vietnam saw America excessively indebted. Vietnam saw it excessively. The biggest percentage gains came from 64 through the 70s. Into the final 80 high, the second half of that. That's your parabola, and that's huge. That's huge. You know, those are huge moves in silver, massive, and that's still to come for us. And as you've shown, it's really just the beginning. We're still at 50. Yeah. They're mining at 6.9. Mag 7 is the enemy of silver because when mining was big, other things weren't getting the money. Because Mag 7 is getting all the money, the conspiracy thought I had, because they want the grid companies to be the go-go boys and to have all the money and to be able to build data centers like this and to borrow as big as they can because they've got cause market cap and value of equity and all of that. If miners start to be you get a rotation out of everything else. And where does all the money sit right now? It's sitting in NVIDIA. It's sitting in Microsoft, it's sitting in FaceAche, it's sitting in Oracle, it's sitting in all of those. So it's going to suck blood from them. Their shares will go down. You'll get contagion. You'll get shorts. They're hopelessly overvalued. Once you get a stampede, you're going to overshoot to the downside. Where's all that money going to run? It's going to not want to lose money. It's going to go where it's gaining. And you get a disorderly rotation because it's self-perpetuating. It feeds. Again, the people always think the reversion to mean. There's inherent stability to our systems. In some situations, you get reversion to mean. And in some systems that's working here, the mean is actually 6.9 produced silver ounces to 1. And you overshoot to the downside when you're going from 126 high. That's the reversion to mean that applies. But there's also certain aspects of the system where you get pushed away from the near center to the dominant extreme on both sides. And you've seen that politically with Democrats and Republicans, where they might have had minor differences, but they were broadly in the middle. Now they're extreme this and the other one's extreme. You've got communists versus, redneck patriots. And in the same way, silver will get pushed to the extreme. The Mag 7 has to fall because once people start getting better results out of it, the capital crowd out that went into via the ETFs, who have played a big part in this, into the same place. And they're not serving you. You shouldn't hold them. They're overpriced. And there's better returns to be made elsewhere. And it's a scale issue. I was having the same discussion. It's the same earlier. It's a scale issue. You need greater liquidity to grow bigger. The smaller you get, the harder it is. It's a self-doom loop. That's why you get pushed to the sides. The smaller caps don't get the attention. Certain analysts stop covering them after a while. They get less attention. Therefore, their share price dwindles, goes down, etc., etc. It's very hard to raise capital, and they become a penny stock. And then you get the go, 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 go. Everybody understands NVIDIA. They make chips. And everybody piles in and wants to say, I own some too. And the ETFs facilitate that. You've got to invert that, When that unwinds in the other way and those things aren't doing so well and people getting concerned, and then they hear about, hey, mining isn't some old industry anymore, it's utterly essential and we don't have enough. It brings really, really core materials to the surface that we absolutely need. And that's, again, I think they're pro-suppressing that. I think all your mainstream media is intentionally not covering silver miners because they're failing in the suppression of the metal, and they've not given up entirely. They've retreated one line of defense back, and they are failing in giving coverage to silver miner equities. Because once the contagion truly starts, you get a massive rotation away from where they want the money, which is prison grid building, to resources where you and I are positioned. And they don't want us to be wealthy, Dan. They want us to be self-reliant. They don't want us to be self-reliant. They want us to be reliant on state, UBI, and they want us to have invested badly. So we do exactly what they tell them. And I'm not interested in being in that crowd.
The mainstream media's refusal to cover the burgeoning silver rally is described as a strategic retreat, in which the suppression effort has shifted from the metal price itself to mining equities. By systematically denying coverage to these stocks, the establishment aims to prevent a wealth transfer that would empower the public, preferring instead to keep capital locked within the prison grid of big tech and government-dependent structures. This narrative underscores a broader battle for financial self-reliance, in which the current system's ultimate goal is to foster dependency on state mechanisms such as Universal Basic Income, UBI. The refusal to participate in this bad investment is a declaration of independence, positioning resource ownership as the only escape from a system designed to strip the middle class of its sovereignty. The coming contagion in tech stocks will catalyze this realization, forcing a reallocation of wealth that the establishment is desperate to avoid. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.